Hi, everyone, and welcome back to the Wide Moat Show. It's great to see you again. And last week was our first episode. This is our second episode. I'm really pleased with the performance from last week. Thank you all for showing up. And Nick, thank you for co-hosting the show.
Yeah, no, it's been wonderful. We love the interaction. You guys left comments, you left questions. I even had some people reach out to me privately with critiques. So, love that. I tell you what, Brad, I gained a major appreciation for the talking heads on TV last week. It's hard to look into a camera instead of looking at a person and having a conversation.
No, you look great, Nick, and I think that's what a lot of people like to see. And I also want to mention to you, a lot of people like to see about this book. Last week I mentioned this is my new book. Published it last year, REITs for Dummies. And last week we had two lucky participants. We're going to send these books to Alex Schiller and Carol M. So Alex Schiller, please reach out to Nick. Carol M, please reach out to me. You can obviously find me on Twitter at @RBradThomas. Again, we're going to drop another book this week. So please reply on the comment stream below, and we'll be sending out books every single week.
Hey, that's the good news. Now we're going to talk about that scary recession word, right? So let's get that, let's have dessert first. Now we'll get into the meat of the conversation.
Absolutely. Well, of course, Nick, I mentioned this last week. Both of us have written articles where we believe a recession is imminent. Last week, the Federal Reserve did keep the interest rates as is, at least for now. I think another one might be coming in May. We'll touch on that in a minute. But Jerome Powell spoke last week, and he said we tend to bring growth down, and they tend to bring inflation up, at least in the short to midterm. Now, it's interesting. I looked at a couple different surveys.
And he's talking about tariffs, right? Is that what he's referring to?
Yeah, yep. I'm sorry, tariffs. And, of course, that's the big key part of this whole conundrum that we're in right now as it relates to potential recession, where rates are, and, of course, tariffs and the impact on tariffs. Now, CNBC just released a new survey last week. The probability, according to their survey, of a recession this year goes from 23% to 36%. Now, let's keep moving. JP Morgan chief economist Bruce Kasman believes there's a 40% chance of a recession. He said, where we stand now is with a heightened concern about the U.S. economy. And we have yet another individual, this time it's former U.S. Treasury Secretary Lawrence Summers, who said on Bloomberg last week, there's a 50% chance that the U.S. will enter a recession next year. So there we go, 36%, 40%, and 50%. You take your pick. My personal opinion is there's a 99.9% probability that we'll see a recession in Trump's administration.
Okay, so I was going to say, because I'll say there's a 100% chance we're going to see one eventually, right? But so you've got a deadline. You've got within the next, 3.5 years here.
Yeah, and I think we'll see one sooner, as we're going to point out here on the show. So again, how do we prepare for the recession, and what are we looking for? So that's kind of the topic that Nick and I talked about this week that we're going to talk about. Now, within my wheelhouse of real estate, there's a tool that I use, and actually this is kind of a really kind of what I call kind of a secret sauce in the world of real estate. What I mean by that, there's a guy named Homer Hoyt. Now, Homer Hoyt passed away in 1984, so a couple years ago. But Homer was a land economist, and he researched business cycles and forms of real estate. I've actually visited his office. They have a Homer Hoyt headquarters there in West Palm Beach, which I've been to several times. I'm going to put a picture on the screen. I actually took this picture of Homer Hoyt here when I was at his office. So the important thing about Homer was, again, he was an appraiser during the 1930s, and he targeted certain neighborhoods, specifically the Chicago area, and he studied how market values have ebbed and flowed over the last few decades. Now, so he created this cycle, and he put together this goes way back over many years in the early 1800s. Now, first off, before we get on the Homer Hoyt model, I'm going to put another chart up here. This shows your typical business cycle, in which you have expansions, you have peak periods, you have contractions, which of course is recession, and then you have the trough. So those are your typical business cycles. Nick and I both learned that in school. At least I did. I went to business school. Nick, you may have learned about this cycle when you were.
Yeah, a little bit. I studied a little bit of everything, but what I do know is that these peaks and troughs are driven by fear and greed, right? They're driven by human psychology, which I think makes a lot of sense, right? Because the kind of the most nervous I've ever been in my life was when I'm making real estate purchases. So I'm not surprised to hear that there's a real estate guy that, that kind of connects all this stuff together. I don't know Homer Hoyt, so I'm excited to hear about what you have to say now.
So yeah, so what he did, he created this. I'm going to show you another chart now. This is the real estate cycle. So in the real estate cycle, you still have that same, expansion, recovery, hyper supply, and recession, but this is all driven by supply and demand. So the real estate cycle is much more predictable than the typical business cycle. Actually, I learned this from a good friend of mine, Dr. Brad Case, who's PhD. I think he went to Yale. He had numerous degrees. Really smart guy. And I think actually Dr. Case, rather, is still on the board of the Homer Hoyt Society, I believe. But he's the one who taught me about this extended real estate cycle. Now, when I was a developer, I went out and I built buildings, and it took me a while to find the site that I was going to build the building on. And then I would put together plans and engineering, civil engineering and architectural plans. And then I would try to find a tenant. And then I go out and find the construction financing. And then I build the building. Of course, there's always weather delays. There's change orders, which is why I don't get involved in development anymore. And then finally, you reach a stabilization of that particular project. So that is exactly why this particular chart here of the real estate cycle is different from the business cycle. So I'm going to show up the next chart. This is the 18-year cycle that Homer Hoyt invented. And going all the way back to 1818, when he first started looking at the history of how real estate performs in these real estate cycles. Now, there are two outliers that you can see on this chart. There was one period, which is really as a result of the 1920s, where we had, really a real estate boom. And then we had a peak period in the 1940s. However, World War II is what caused this economy to really be delayed, and it was all dedicated to the wartime efforts. So that's why you have, looking at this chart again, 48-year period, which is another outlier. The other time period I want to point out is in the 1970s, where there was high inflation and tangible goods were really where everybody was investing. Gold, silver, even land rose in value, and the Fed stopped the rapid rise of money supply chain, which caused the recession of 1980. So, but we factor out those two periods, and you look at where we are today, we're at the bottom of the ninth inning. In other words, we are right now, using Homer Hoyt's model, we're right there into that recession territory based on supply and demand. And again, those numbers that I just explained earlier. So anyway,
those charts are crazy, bro. I'm sitting here doing a little math in my head when you're talking, and what do you say? We line up right with the Great Recession, 2008, and yeah, I mean, that's a scary thing, right? I mean, I know you're a real estate guy. You kind of struggled during that period with your real estate business, which I think is kind of why we wanted to have this conversation today. I think you, more than most, I think, are pretty well equipped to talk about a recession, talk about bear markets, kind of how to handle them, what they do, how to get through it, et cetera. So, you obviously finished up this Hoyt conversation, but do you want to talk about your experiences in the Great Recession and kind of how that shaped how you think about recessions today?
Yeah, 100%. So look, I mean, I think the Great Recession, everybody calls it the global financial crisis, whatever flavor you want to call this. It was a very difficult time. And I can tell you, kind of leading up to that, I was just coming out of my own recession with a business partner. It's more of a depression, I guess, with my business partner than a recession. And so 2004-5, I ended up, leaving my business partner and trying to untangle a big mess of real estate that we owned together. And I went to work with these home builders who were very successful home builders, regional home builders. They had just sold their previous business to a national home builder, to Pulte. So they started all over again after their non-compete ran out. And they started just building home after home after home. So I remember in 2007, late 2007, I was walking into my friend and business partner's office, and man, I could just see the look on his face. There was like sweat coming down, and I said, Ted, what's up, man? And he said, we can barely meet payroll. Our banks have called all the loans. Two major banks had called their loans, and they had to shut off all the construction. Now, they were fully integrated. They had mortgage, they had landscaping, they had every, kind of soup to nuts builder. They were going to sell this to another, big builder, and they just, obviously nobody could have predicted this. And they had to liquidate everything quickly. And I've never seen just hundreds of jobs go to 3 jobs so quickly. And of course, my whole world changed. I had to go find a job, which I did. And then it's because of that job that I started writing on Seeking Alpha, where I met Nick and some of the other analysts there at Wide Moat Research. And so, I definitely have experienced some very difficult times. The banks weren't lending any money. I couldn't really go build anything. There was, I think, 500 banks that closed during that time period, during the global financial crisis. So it was certainly a difficult time. But Nick, I think you were in school then, right?
Yeah, no, I mean, happily, I was the first year at the University of Virginia, and all this, I didn't even know there was a recession happening at the time, right? I was trying to figure out where the party was that night, make sure I got to class the next morning. So I guess lucky for me, my parents did a great job of hiding it. They must have been struggling, really, really badly as well. And, it's kind of the crazy thing, but I will say, I invested obviously through the COVID crash just a few years ago. And, that it's crazy times. There were days, I think, during the worst of that volatility where, I'm seeing 5-6 figures worth of value just fall away from my portfolios in a single trading session. And that is that's not pretty to hear. My wife comes home from work, what's wrong with you? Well, how do you tell somebody, hey, we just lost $100,000? But the beauty of it is it really, I didn't lose anything, right? If you don't sell at the bottom during those moments, if you have kind of the intestinal fortitude to get through those times, if you prepared mentally, you can come out the other side doing just okay. I think the S&P 500 is up triple digits since the bottom of March 2020. My portfolio is doing quite well. I was buying during that downfall. I knew what I wanted to buy, and I went ahead and pulled the trigger, made a bunch of money. So I think that's kind of the key today, right? Recessions are very scary. That word's all over the TV. You hate to hear it. You don't even really know what it entails, but it's bad. But it doesn't have to be bad, right? Everybody kind of focuses on all the negatives associated with recessions, and job loss, things like that are horrible. We certainly don't wish that upon anybody. But these are opportunities that investors can capitalize on, and that's kind of the theme of today's show. And with that being said, I want to discuss what a recession is, because I feel like it's like Charlie Brown and Lucy. I think the politicians, they keep moving the football. It used to be just 2 consecutive quarters of negative GDP growth. That was a pretty simple, cut and straight definition of what a recession was. We had that, I believe, under the Biden administration, but all of a sudden, hey, it's not a recession anymore because employment's still good. Which is good. I'm happy that employment's so good. But, when you kind of change the definition, it confuses people. Confusion leads to uncertainty. Uncertainty leads to fear. Fear leads to poor decision making. So kind of what I want to say here is that it doesn't matter what definition you want to use for what a recession is, two quarters of negative GDP, et cetera. That's what I'll use. That's what's been used, I feel like, for 100 years. Let's just stick with that. But that doesn't even really matter. All that matters to most people who are looking at their investment portfolios, who have 401ks, who are, kind of banking on their retirement accounts to retire, they just care about market volatility. So that's what I want to discuss here in a minute. How these recessions, how these bear markets impact the stock market, and then what we can do about that as investors. So with regard to kind of how the stock market reacts to these sort of negative, scary recession, headlines, Ed Yardeni, he's an analyst that I think Brad and I both like. He posts a lot of really just data-driven fundamental analysis. I've got some notes here, so forgive me for looking down, but I do want to get the numbers right. What he did, and I'm going to put it up on the screen here, Ed put together some charts of every single bull market and every single bear market that we've had in like the last 100 years. You'll see on the screen here how long they've lasted, the amount that the stock market went up or down. And I think knowing these numbers, knowing what you can be kind of have in store when a recession comes is really important. So the average bear market, according to Ed, that's negative 20% on the S&P 500, has lasted 340 days. So that's not good, but it's not that bad, right? That's less than a year. I think everybody here can get through a year of pain, hopefully. And then you're back to your gains. The average downfall during that period of time was 36.6%. So once again, that's not good. Nobody wants to experience those sort of losses. However, it's not the end of the world. It's not, 80% losses. I think it only happened one time during the Great Depression. And then the stock market has always recovered. And with that in mind, let's get to the bull market stats. The average bull market is over 1,101 days. So roughly 2-3 times the size of the average bear market. So if you can get through those tough periods, you have really great, things in store. The average gains during those bull market periods is 121.4%. So once again, we're talking, two to three times the gains compared to the average losses. These are all averages. Brad and I don't know what's going to happen. I think we're not calling for like a depression era event right now. We think, it makes sense for the market to correct itself every few years. And that's kind of what we think is going to happen. And that happened last week, right? The S&P 500 hit negative 10% from its highs. And then I heard, I don't know who it was. It wasn't Rick Santelli. One of the guys on the CNBC said that every time that happens, every time you get a 10% correction, only 40% of the time does it go to negative 15%. So most of the time, the stock market just goes back up. It continues to go higher, which makes sense if you look at this Yardeni data. So I really think that's important for people to understand is that, yes, recessions can be very scary, but on average, you just have to be tough for less than a year. You get through that year, then you're off to the races again. And then, and that's, during that year, if you have money, hopefully you've put away some rainy day funds. We'll talk about kind of asset allocation here in a minute. That's the time to be buying beaten down, wonderful companies, taking advantage of this short-term correction so that you can, really prosper over the longer term. So that's what a recession is. That's what's likely to happen based upon averages on the market. Like I said, take a look at the screen. Maybe just pause the video. I know it's a lot of numbers there. Just pause the video, look at the numbers. I think they'll make you feel better about yourself, about the market, about your portfolio, et cetera. They're not that scary. And with that in mind, I think next we'll go to why do we think this is happening, right? Like, why are all the headlines all happening all now? We've got the Homer Hoyt 18-year cycle. That's pretty interesting, but I don't know too many people know about Homer Hoyt, and two, I'm not going to necessarily buy and trade stocks based upon an 18-year cycle. If it proves to be right again, maybe I will, though. We'll see. But I think Brad and I both agree that Trump, his White House and the changes that he's making with policy right now is probably going to be what inspires this short-term correction. And that's coming from somebody, Brad, I know I don't want to speak for you. I'm a big Trump fan, I believe, and a former advisor to the president and a close personal friend. So, I don't know Trump, never met him, may never will. Brad, on the other hand, has. So I think he's a great person to speak to this. So, Brad, what do you think about the president's decision-making right now? Does it surprise you? How is it impacting the economy? And is this something that, investors should be worried about?
Yeah, well, first off, let me remind everybody, we are not market timers. Nick, thanks for pointing that out. Homer Hoyt 18-year cycle does not suggest that we're market timers. If you think we're a market timer show, we're probably not the right fit for you because we're really fundamental analysis. And what we do, and again, Nick, thank you for pointing out that information. That's extremely helpful to me, hopefully to our audience as well. And also back to Trump. I mean, certainly I know Trump well. Certainly don't agree with every decision he's made and all of his opinions. But certainly we try to look at all of this thing conclusively and make decisions based upon all the evidence we see. Now, the great thing at Wide Moat Research is we have access to a lot of research across many different sectors and different categories, not only just real estate or real estate investment trust, but all types of sectors. This morning, I was reading some news on the airline sector, and actually it's holding up pretty well. Not great, but I can't really see recession, yet coming. I was looking at the cruise lines this morning. I read a paper on Carnival, and Carnival actually has done extremely well with their bookings of late. So that sector is holding up pretty well. I'm writing.
I'm not going to lie to you. My wife texted me today, and you might be able to guess what she asked about. I think the next Disney vacation might be getting put on the books this evening. So the Ward household isn't slowing down either, right? I think anybody that's been to Disney knows that that's not necessarily a cheap thing to do. I love it. But Disney's, I think Q3, Q4 results will be aided by my family. So I think you're right. If I was really scared, I'd tell her, no, I don't know about that. I don't know that we need to go to Disney right now. But I think, my response was more of the, sure, let's pull the trigger.
Yeah. So again, I think it's the combination of the Doge impacts, the jobs, as well as the tariffs. And again, we still don't know exactly how Trump's going to play all these tariffs cards. But what we do know, in one sector we cover is the home building sector, where according to a lot of market analysts, the price of a home is going to go up to roughly $10,000 for the price of a new home. That can range anywhere from $3,500 or higher. Now, also a new car.
And that's because of tariffs, right? That's what you're talking about, because the cost of goods coming in.
Correct. So the impact for both cars and houses, washing machines, I think that's going to be impacted. So again, I think you're going to see a lot of those impacts. So Bloomberg had a report out this week that said there's going to be $1.8 billion potential impact on on the tariffs. Now, let's look at the positives. Now, what Trump's hoping for, and I think, Nick, you alluded to this as well, is short-term pain for long-term gains. Now, let's talk about some of the long-term gains. Recently, we had several large announcements, and this is exactly part of Trump's playbook. Hyundai just announced $500,000 of new units in Savannah, Georgia. And today, Hyundai announced another major $20 billion announcement, new plant going in for EV cars. So certainly that's going to be a large investment from Hyundai.
Yeah, I saw that they're building steel down in Louisiana, I think, right? So yeah, congratulations. If you live in Louisiana, you're a steel builder. You just got $5 billion worth of new jobs.
Exactly. And connect all these dots. Honda's investing $4.5 billion for a new plant in Ohio. Volkswagen, $2 billion in Columbia, South Carolina. That's 2 hours from me. Volkswagen is evaluating also production for its Audi and Porsche brands. I'm hearing news that Porsche is going to make an announcement pretty soon. Inventec, which is a supplier of AI servers for NVIDIA, is looking at potential sites in Texas. LVMH, which is the luxury conglomerate, is seriously considering U.S. production and capacity in the U.S. Campari, I don't know if I pronounced that correct. They're an Italian spirits maker. They're assessing U.S. expansion opportunities in the U.S. Compal Electronics, a Taiwan-based laptop manufacturer, is in talks to invest in the U.S., and they're looking hard at Texas. LG Electronics considering a refrigerator production from Mexico to Tennessee. Here again in South Carolina, just an hour from me, Samsung has announced they're going to move their dryer manufacturing, again, from Mexico to Newberry, South Carolina. So there's a lot of new investments that are coming out almost every day. And again, that's exactly what Trump was going to hopefully design with these tariffs. Now, it's going to take a longer time period for those actual return on those investments. But it appears that could be exactly what Trump was hoping he could do. So anyway, we'll see what happens. But I think we are starting to see what I refer to as a building boom, where I think we're going to see a number of new manufacturing plants, new warehouses, part of this whole reshoring concept here coming to the U.S. So anyway, that's
interesting that you say that. Yeah, because that's kind of the long-term end game, right? Because you know this as well as anybody. You can't build a factory in a week. You know, these things take years probably to do. So this isn't something that we're going to see the economic impact of right away. But I wrote a Wide Moat Daily on this last week, and I think you kind of agree with this concept as well. In the short term, there could be another reason why we're seeing these tariffs, and it's strategic potentially. I saw a lot of headlines, people saying Trump's playing 4D chess. I don't know if he is or not. Some people say maybe he doesn't even know about this, and this is just a happy coincidence. But apparently, kind of depending on the way that you look at it, if you look at debt maturities and what agencies own these notes and things like that, there's roughly 3 to 9 trillion with a T. That's a big number. Amount of debt coming due in the next 6 to 12 months in the U.S. In that WID, we talked about that's I'm sorry to look down here. I want to get these numbers right. If you we can't pay that debt back, right? First of all, we have a $1.1 trillion deficit in the first quarter of the year fiscally for the country. So can't pay back the money. We have to refinance it. If we refinance that at the 4.8, 4.5% where we're at, that's going to be $430 billion of net income expense. However, if Trump could somehow inspire Jerome Powell to lower the interest rates, if it gets down to 3%, we're at $270 billion. So that's, a lot of money saved on interest expense just by lowering the rate. So Jerome Powell's not going to listen to the president. The Fed needs to maintain its independence. I think most people agree with that. That's why the dollar's strong. That's why America is America. We don't have a central bank that's going to be manipulated by either party, and that's a good thing. But rates coming down would certainly help our country. We have the government just released their kind of debt report. We're at 36.22 trillion in debt. That's 1.8 trillion more than it was a year ago. That's not good. Trump has said that he's the king of debt, so he knows how to manipulate this. We'll see if that's true. More recently, he has talked a lot about lowering interest rates as well. In a Fox interview, I think 2 weeks ago, he said, nobody gets rich when interest rates are high. That may or may not be true. I think people can get rich in any economic environment. However, it's certainly easy to do when there's a risk-free money to be had. So I'm sure Trump would love to see rates fall. And that's the kind of 4D chess that he may be playing with these tariffs. I don't know that it's about fentanyl. It may be. I'm not a policymaker. From what I've heard, there's not a whole lot of fentanyl coming in from Canada to the U.S. However, there is a lot of debt that needs to be refinanced. So any way that he could to inspire an economic slowdown and to get those rates lower and to get what he wants with this reindustrialization process that you just talked about, that could be a major win for the country and for his administration here in a few years. So it'll be interesting to see how that plays out. But I think, like we said, we're not market timers. I don't know when that's going to happen. We're not political analysts either. What we care about most is how to capitalize on these moments from the market. So, Brad, you kind of touched on this during your spiel there. One thing I heard South Carolina, I heard Louisiana, Texas, the Sun Belt. That's what I heard. Every single town you just mentioned was in the Sun Belt. And I think you have a pretty interesting investment idea to kind of capitalize on this trend within that specific region, which I think is going to see growth, probably regardless of what the economic, broader picture is in the short term.
Yeah, absolutely, Nick. And I think, what I'm going to talk about here, and this is my pick for today, for the week, is a company who is really located right here in what I call the boom belt, not the Sun Belt, not the Bible Belt, but the boom belt. This is Eastgroup Properties. They're based in Ridgeland, Mississippi. The company has 536 industrial properties in 12 states. Now, when I say industrial properties, let me be clear. They're not really your traditional big warehouses leased to Amazon or Best Buy. These are flex space buildings. These means they're buildings that are about 100 to 200,000 square feet, and they're cut up with different bays. So these different users could come in with maybe a limited amount of office. Maybe they've got some warehouse in the back. Maybe they got some manufacturing. Maybe they got some lab space. But that's referred to as flex space. Really interesting. That's 63 million square feet of that. So it's an extremely diversified portfolio. The top 10 customers only represent about 7.2% of their annualized base rent. And 75% of their revenue is generated from tenants that have less than under 100,000 square feet. So very diversified business model.
Well, and that's interesting too, right? Last week we talked about, Prologis, great company, but they're competing against Amazon. And I don't know about you, but that's a scary thing for me. I don't think Amazon probably deals very much with these small flex space, industrial warehouses. So if anybody was worried about Amazon, this might be the pick for you.
Yeah, so Amazon, Prologis certainly has the scale advantage. I talked about that last week. Sunbelt, Eastgroup has mostly a Sunbelt focus, again, a boom belt focus, primarily in what I call the smiley state. So that takes you from really the Carolinas, North Carolina, down to Florida, over to Texas, over into Arizona, and even into Florida. So that's kind of the smiley part of the U.S. Again, it's a multi-tenant business model with flex space, so that provides a lot more diversification as well. Some of the key things that we were looking at with this company is that in 2024, I'm going to put a chart here, the company decreased their construction starts by 27%. Again, this game is all about supply and demand. So we've seen a reduced supply, and now, as I just mentioned, with all these new companies, the reshoring, we're seeing enhanced demand that's going to take place. It's already starting under Trump, and it's going to continue to move forward. And again,
and just to be clear for people, when that happens, guess what do? The companies pay more rent for these spaces that already exist. Yeah, right. So I'm assuming they're seeing some really good year-over-year rent growth right now.
Absolutely, they have what we refer to as pricing power. So they release property, they're able to release at higher rents. They're also able to retain their customers as well. So retention and releasing are some of the key metrics we look for. I'm going to put on the screen here too. There's a pretty good sized portfolio up in Charlotte, North Carolina, that's very close, about an hour away from me. And there's another one right here in my hometown of Greenville, South Carolina as well. So they've got properties really, really close to me. I can go look at them as an investor and see how they're performing. And of course, I drive around this market and see all the activity that we're seeing here in the Carolinas. Now, in terms of the balance sheet, Eastgroup has an exceptionally strong balance sheet. I'm going to put a couple other charts up here, but let's start with the current debt of the company. They have one of the lowest levered balance sheets in the industrial sector. So that means they have about 16% debt, the debt ratio, as well as debt to EBITDA about 3.4 times. So that's actually, they don't have an investment grading, but it's definitely one of the lower leverage balance sheets. And that's going to really provide them with a lot more predictability in terms of their earnings profile. The other thing I'll mention in terms of their fundamentals, they have increased their dividend. I think it's for 13 years in a row, but ever since they were a public company, they've maintained their dividend, and that's been around 32 years in a row. So that's a pretty strong track record and a very good indicator of the quality of this business model. Shares are extremely attractive today.
What's the yield, Brad? What's the yield on that dividend?
Yeah, so the yield is not that great. It's 3.1%, but you've also got to consider the fact that they've got a low payout ratio. So I'd much rather have a safe dividend, a reliable dividend that can grow over time. So again, they've got a very good track record of growing that dividend, and not a sucker yield, which is a higher yielding company that's not able to maintain that dividend. So about a 3.1% yield. Now, what's really attractive, again, analyst consensus have this company growing by about 10% this year, 10% next year, and around 15% 2027. Again, that's when all of this building boom takes place. We're starting to witness now within the Trump administration. So again, this focus on these Sunbelt markets or these Smiley State markets, I think is really important. And I really like Eastgroup a lot. So that's kind of, to me, a good way to play it in real estate. Shares remain attractive, trading a little bit below their normal valuation level. So I think that's a great pick today. And Nick, how about you?
Yeah, no, that's interesting. Cause I like the kind of longer term. Like you said, I can imagine a stock like that might struggle in the near term, especially if we do see an economic contraction. However, that they have the great supply and demand metrics you already said, and all that building is going to happen in the region that they really specialize in. So it sounds like, 3 to 5 to 10 year period. This is a REIT that's got a lot of growth ahead of it. And I like that too, right? I know there's people listening to this that just heard 3.1% on a REIT and they kind of turned their nose up. But let me tell you, you're going to be very happy to own a safe 3% yield that's growing every year, way more than you will when that yield gets cut. Because when dividend yields get cut, you know what happens? The very next moment, share prices fall. And that's so, you're losing your principal and your income. Neither one of those things are good. I kind of went a little bit of a different way. Instead of thinking about one stock, I kind of wanted to talk about how I think about buying stocks during a downturn. And I feel like I'm looking for two things. I'm taking a barbell approach, one over here, one over here. I want to have secular growth on one side of that barbell. Secular growth just means growth that's going to happen regardless. It doesn't matter if we have a recession, pretty much anything outside of like a nuclear war. You can expect things like AI, like data center growth, like the energy to power all this to happen. We saw that happen with e-commerce in the last decade, with the cloud proliferation, with mobile growth from PC. I want to capitalize on these big trends. Obviously, right now, the big trend is AI. There's several ways to play that. I'll talk about that in a moment. On the other side, I want to have really defensive investments that I can count on, kind of like the company you just mentioned, Brad, that, just people are going to buy these products no matter what. I had the flu this week. You guys may have heard me coughing some. Thank God I'm getting better. That was pretty miserable 4 days for me. And I told Brad the other day, there was no amount of money that I would not have paid for some NyQuil. I want the real thing. I want Procter & Gamble. I want the P&G brand. I don't know if it works better than the store brand or not. But when you feel that bad, man, I think it was $16 a bottle. I would have happily paid $50 a bottle. I needed some relief. And, the same thing goes for toothpaste and toilet paper and Coca-Cola. And maybe you can even mention your iPhone. I can't imagine going through your day in the 21st century without your iPhone. That's why some people think Apple doesn't really trade with like a technology valuation. It trades more with like a consumer staple evaluation, because that's what it is in 2025. So I want those two things. I kind of wrote down, I've been buying a lot. I spent put a lot of money to work in the last few weeks. Some of the things I've been buying are things like a Vertiv. They do data center cooling. So I own a lot of chip stocks. I didn't really want to go any more into that industry. I wanted to stay diversified. Vertiv cools down all these data centers, provides software, and builds them. So it's a nice kind of ancillary play on data centers. I wrote down that they're trading for 29 times right now. That's an expensive valuation, but they're growing at 26%. So from a PEG ratio, that's basically a 1.0. That's actually pretty cheap. So they're down, I think, 45% from the high. I found that interesting. GE Vernova is another company I've been buying a lot recently. They're really into natural gas turbines, wind, solar. They've mentioned nuclear. Pretty much every way you can generate power, GE Vernova is doing so. They're trading for like 43 times forward right now, so pretty expensive. Like I said, growth company, you got to pay up for that. But they're expected to grow their earnings at like 40 to 50% over the next like 5 years because of these massive secular tailwinds going on with energy and just all the energy we need to power the AI growth. So that's interesting. And then what I like to do too, and I think everybody needs to do this, and this is how you stay sane during a market pullback. You have to have a shopping list. You have to have a list of companies that maybe you don't own because you've always thought they were too expensive, or a company that you sold one time and you've just been kicking yourself for it for years. Just for whatever reason, something that you don't own that you really want to own. Usually for me, it's because they're too expensive. Some names like CrowdStrike came to mind, the number one cybersecurity company in the world. I don't want to pay 100 times for that, but I probably pay 50, right? So if the stock got cut in half, I'll probably own some CrowdStrike. Costco is another one. That's more of a defensive company. Charlie Munger, RIP, says called this like the best company in the world. They're so good, people pay them money to shop there. That's how good their experience is, right? Most of their money and a lot of their margins comes from those membership fees. Well, they're a retailer, and I think they're trading for like 50 times right now. I don't understand it. I've never understood it. I've been saying this for a decade though, right? Costco is up probably 1,000%, and I've been sitting on the sideline because I don't understand the valuation. If it ever goes down to like 25 times, I'm going to be a Costco buyer. The only time I'm going to get that opportunity is if the market crashes. So you have to have things like that you can look forward to. So when everybody else is running for the hills or burying their head in the sand or whatever, you are staring at that COST ticker, just loving it, watching it drop so that you can have something to do with your money. So that's what I want to do. I want to have secular growth on one side. I want to have defensive things on the other. And I want to have a shopping list of really high quality companies that I've just regretted not owning for years, and that, I'm going to own during that pullback. And that's going to kind of be, looking back, pullbacks, that's what they are. They're a pullback, they're a dip. It's going to stop. And I'm going to be so happy that I bought, company X, whatever it is, some high quality company during that pullback. So that's kind of my spiel on what I want to do during a pullback, Brad. And I think we're going a little long here, but I do think it's important to touch upon diversification. I know that both of us wanted to kind of highlight that really quickly. So let's talk a little bit about portfolio management, and then we'll wrap this episode up.
Yeah, and I think, Nick, you've already touched on a lot of these things. I think it's because of this sustainable high cash flow that these companies are able to, have these premium valuations that you've mentioned. So that's what we do here. We analyze these companies' income statements, balance sheets, because we're recognizing that a substantial portion of these asset values of these companies come from as a way of these predictable cash flows that these companies generate. So earnings are a really big predictor for us. And when we buy these companies, when they fall off, when they're being ignored or Mr. Market doesn't pay attention to these companies, that's when we want to buy those companies. So I think, Nick, to your point also, I think having an asset allocation target or blueprint is the key to the success here, because every investor is going to have his or her own personal tolerance levels. Nick, you're younger than me, so you've got a different time horizon, and time horizon is, to me, one of the most important parts of how you structure a portfolio.
Yeah, that's I think the most right. What's right for me may not be right for you or anybody else, and so that's really important for viewers to understand. We're not financial advisors here. We're not giving anybody specific advice. But everybody needs to have that plan for themselves, right? You need to understand your risks, your goals, your dreams, your income, your debt, all that. It takes some work, but you can do it. I'm not a rocket scientist, and I figured it out. Understand your thing and have a plan. Because I said this, there's that famous Mike Tyson quote, right? Everybody has a plan until they get punched in the mouth. It's a little bit of a cliche now, but I think it's super true, right? It works in the heavyweight boxing ring, but it also comes to play with the stock market. It's easy to say, I want to be a dip buyer when the market's at all-time highs. It's not easy to do it when the stocks are crashing 25, 30%, right? So have a plan and understand what you want to achieve with your investments.
Yeah, Nick, and I think you're absolutely right. And I think going back to diversification again, when in 2008, Great Recession, I had most everything I owned in real estate. And I learned a valuable lesson, and that is to always diversify. And even though I love real estate, I'm not going to put all my eggs in one basket like I did one time, because it took me 15 years to claw back from those really tough times. So I think that's really some of the best advice I try to share with our readers and our audience here at Wide Moat Show, is to always maintain adequate, responsible diversification. There's a quote that Sir John Templeton once said, and of course you know who the Templeton, Sir John and the Templeton Company is. Sir John said, the only investors who should not diversify are those who are right 100% of the time. So it's always important. As much as I love real estate, I'm not investing everything in REITs or private real estate. I think it's important to spread that exposure across multiple different asset sectors, and always know that business that you're investing in. And Nick, you make some great points here in understanding exactly what these companies are doing that generate these high, predictable cash flow streams. That is the key to success.
Yeah, no, just to be clear, we're not right 100% of the time, right? We know that, and that's why we stay diversified. Like, quickly, Brad, you're the REIT guy, and like I said, we're not giving financial advice here, but is there a cap for a real estate exposure within maybe just your portfolio? Is it 5%, 10%, 20%? Is there a level that you just will not exceed?
Yeah, well, actually, in my book here, and I'm gonna remind everybody again, drop us some comments, and I'll definitely send out one book a week. But in the book, I mentioned there's actually a whole chapter dedicated to portfolio management. And I talk about, I have a little bias because I know real estate pretty well, and I've done this for, over 30 years, 3 decades. Wow. And so, my risk tolerance level is much higher. However, going through my difficult times, I try to keep my exposure somewhere between 30 to 40%. Now, I do think we're entering a period that we're seeing right now where a recession is actually going to be a good thing, because I think it'll force rates down if we enter this mild or garden style recession that I keep talking about and writing about. But I think we're going to see that. We're going to see some rate cuts, and that is going to be the jet fuel for not only real estate investment trust public companies, but private real estate as well. That cost of capital really is going to help drive the earnings and dividends for these companies. So I would say today, for the individual investor, for many of you who are watching this YouTube channel, average Joe or average Jane, I would say somewhere responsible would be around 10% allocation. Now, if you really are into it and you see the valuations like I do and the opportunity set, by the way, next week we're going to be talking about power of compounding. Nick will tell you in just a second about our next week. But if you believe in the power of compounding valuation, you could possibly look at a 20% allocation as a higher end range. But I would say for average investor, 10 to 20% based upon his or her risk tolerance is reasonable, in my opinion.
Yeah, no, I think it seems about right. I kind of a do what I say, not what I do situation. I think my portfolio is probably 50, 60% technology right now, but that's kind of where I focus, right? So that's where I feel really comfortable. What Peter Lynch is famous for saying, buy what you know, right? So whatever you guys feel comfortable with, that's what you should be owning, because you certainly don't want to not know what you own and not understand it. And that's, with buy what you know, I am so excited. Next week, we're going to be talking about the power of compounding. People that know me know that I talk about owning compounders. That's kind of what I like to call the companies that I focus on. These are companies every single year in and out. They're growing, they're compounding. That's what I like to see. I'm happy to pay up for those. So we'll talk about that. We'll talk about dividends and dividend growth, and how seeing these charts and the tangible nature of compounding, that's really what can allow you to sleep well at night in the market. So that's going to be what we're going to talk about next week. We hope you guys enjoyed this week's show. We hope you'll come back again next week. Remember, these are every Thursday. And then, and please give us a like on the video. You can subscribe to the Wide Moat channel, and there's a bell down there somewhere you can click that'll give you notifications when we post new videos. So every Thursday, that's our goal. But just click the bell if you really don't want to miss us. You'll get a notification. And, you'll see us week in and week out. And I can't wait, for next week's conversation.
Thank you, Nick. And hope everybody has a great week, and happy swan investing. Thank you for watching this episode of The Wide Moat Show. Don't forget to subscribe and comment below. And for those of you who comment, I'll be sending out one free book every single week for the person who comments in this stream below. If you enjoy what you see, please sign up for the Wide Moat Daily below. Have a great day. Thanks for watching.